Goviex is different. We're everything in Africa. We focus totally on the African continent. We're only in uranium on all of our projects. What makes us different? We've consolidated a whole bunch of different projects, advanced them all the way through to the mining permit. So we have 2 fully permitted mining projects. That is key in our industry. It does take you 10 years approximately to permit a project in Canada. So if you think the cycle is going to turn, it's the companies that can actually build into that cycle are the ones that are going to make that first real turn and the cash flow. It is a very large resource. We have over 220 million pounds of uranium in the ground. We stopped drilling 5 years ago simply because we felt we already had enough pounds in the ground, and therefore we knew where we could expand to. On our Niger project, we're on the same structure as Areva have been mining for the last 45 years. We've got effectively 12 kilometers between our deposit and their deposit in the same ore body. So we could just keep drilling towards them and expand the ore body. We've got a strong pipeline. We put together the profile of advanced projects. We didn't need any more exploration within our portfolio. I had enough of that already. So what we've targeted is projects that already have PFSs on them and are ready and permitted to go into production. Interesting shareholder group. We've got Denison. Cameco was actually one of the very first shareholders, and Ivanhoe. Main project is in Niger. It's right next to Areva's mines. All the infrastructure is there. People, power, roads. Surprisingly, water as well. 40 meters below the surface, we hit water. We're actually going to have to drain the mine to be able to operate, which is slightly surprising in a country that has 10 millimeters of rain a year. Matanga, right down by Lake Kariba. It is 3 permitted projects right next to each other. Interesting thing about Zambia is Zambia wants to defer away and diversify from copper and wants development in the south. We happen to be right on the southern border. Fully permitted project. We expanded that last year by adding another asset to it. And then finally, Falea, which is on the Guinea border. It's got about 30 million pounds of uranium. It has a PFS. It's a project that really needs a lot more drilling. It comes with silver and copper credits that go with it, which we really don't understand enough about. It is an unconformity style property, but it's last in the line, and we've got 2 projects to build before we get to that one. So one of the largest, interestingly, most of our pounds have already been converted to measured and indicated. That's a function of actually de-risking these projects ready to go into production. Briefly, I've only got 2 slides on the market. Straightforward. All of the forecasts you look at, you're looking between 3 and 4% per annum growth on reactor build, nuclear demand. We're back at 2011 numbers on total generation. I think the general consensus is the world is realizing that you need reactors out there. Clean energy in renewables is not going to make the difference. The key, though, is that we've seen the production cuts coming through. Market's now into deficit, but looking forward, we have another 3 projects in the next 5 to 10 years that will actually just close simply because they've run out of anything to dig. That's about another 20% of world production coming off stream. Secondary sales are again dropping about 15 million pounds over the next 4 years. So again, that's another large mine required to come into development. Costs are way too low from a price point of view. Your costs are higher, about $40 to $50. You need at least $60 incentive price to build out there in the market. We did an analysis of over 70 different projects with their potential start dates and their incentive costs. We can only get the model to balance at $60 from a starting, and then it only balances for a very short term because a lot of those projects are the small ISR projects in Canada which come off really quickly and they still need to be replaced themselves. So what is our strategy? We believe we're starting to see that turn. Cameco's action by shutting McArthur River is certainly tightening the market. We expect them to be buying inventory later this year. That'll further tighten the market up. Expect them to delay their restart of McArthur for at least another year. What does that mean? It means rising prices going forward. Goviex is in that position where it can actually get out there and start building. So we'll start finalizing the final feasibility study. It's 2 years of construction, so 3 years from now, expect us to be producing on our first project in Niger. We then have the second project in Zambia to follow it thereafter. We're one of the few companies that's actually got more than 1 uranium project as well, so we're able to be slightly flexible in the way that we operate, certainly with regarding contracting and the methodology and start times. Niger, it's a currently 21-year mine life, producing just under 3 million pounds per annum. Cash cost is $25 a pound. As I said, all the infrastructure is there for us. This project will probably more than double its life of mine. What we are doing going forward from a project point of view, though, is effectively getting it ready to start. So our focus firstly is on optimizing the project. Last year we had a license re-granted to ourselves. In Niger, when you renew a license, you have to cut it in half. Unfortunately, when we cut it in half, it took the half of the open pit away. So we've now got the open pit back. It's not part of the feasibility study, but it happens to be the upside of the open pit. That will mean the first 8 to 10 years of the mine life is open pit. We then go underground. Underground, in our case, is flat-lying, 100 meters down. The main deposit currently is 7 kilometers long by 3 kilometers wide, and it's flat. So it's a room and pillar operation. So we've been looking at things like nanofiltration here as well. The ability to recycle a lot of our chemicals will result in our OPEX probably going down by a further 10% and reduce our CAPEX by another 6%. The other thing, the industry has changed a lot on the way you can build mines. There's a lot of modularization. Every single part of that plant can actually now be pre-constructed offshore and delivered by truck to the site. That will speed up the construction site, but also reduces our risks in country on a build. So that's going to be key for us as well as how we can develop that program going forward. We've also been working on the debt. We realize we're in the middle of Niger. There was our own concerns that that was going to be difficult, but we do have expressions of interest from 2 export credit agencies and 4 banks that indicate we will get 2/3 of the capital covered by debt on this project. So we're already working on that, and we have started the initial discussions on the offtake as well. Second project is Matanga in Zambia. This used to be owned by Denison. They permitted it in 2009. They then increased the size of the resource by adding another large deposit. Last year, we acquired 2 more deposits from the company next door, Africa Energy. That's now given us a substantial structure. There's a 50-meter gap in the middle of the mining permits as well, which is mine permitted. We have trenches in that indicate we should be drilling when the time is right, but it already is 11 years at 2.5 million pounds per annum. This is very simple, open pit heap leach operation. Acid consumptions here are 1/10 of the ones we have in Niger. Stripping ratio is less than 2 to 1. Very easy mining, very easy to get going. And those eases compensate for grade. Management team, we've all been in the industry in various parts for a long time, a lot of experience in uranium. I've actually worked on every single continent except for Antarctica. I've worked in about 10 different metals as well, and I've been an equity analyst at the same time. So, you know, we've all been around and had a lot of experience. Got a good board. The founder is Goviex Freeland. David Cates is from Denison. Chris Wallace is a debt guy. Ben Wallisal is key for West Africa. He's the founder of Semafo Gold, so has a lot of contacts in West Africa. Those are our major investors. We're currently cashed up. We do have a debt on the balance sheet, but we've already agreed to get rid of that at 50% of face value, and we've already paid for it. So we're waiting to finalize that transaction, and then we'll be debt-free effectively by middle of next month. So that will have cleared us up, ready to go, and had removed the security as well. And this is really the key. We're sitting at a massive discount to our peers. So we've got one of the largest resources. We're one of the few companies that is fully permitted that when the cycle turns. I always argue this is like the dollar trade. When the market's tough, everybody buys US dollars. When the market changes, everyone gets to every other country because you don't want to be. This is exactly what happened to Paladin. Paladin went from 7 cents to $7. It was an undervalued African developer. It developed mines in the cycle, and it went to $7 as a change. The other thing to remember is that 3 largest transactions in the last cycle were all done in Africa, and the minimum was 1.2 billion for a project half the size of ours with a grade, a third of our grade. So Africa is a great place. Why? Because the major producers, the Chinese, the Russians, want projects they can buy, that they can own all out, and they can build. So that's the other side of it. Okay? Thank you very much.